You are listening to Compound Money Quietly, the CMQ Investing Podcast. My name is Chris Franco, and in this episode, I'll be sharing with you the latest updates on how I'm investing my money. But first, if you have not yet followed the podcast on Apple Podcast or Spotify, please take a quick second and do that. That way you'll be first to receive updates about these new episodes, and you'll also be among the first who are able to not just have the information, but use the information. Right off the bat, the first thing I like to look at is the distribution between index funds and individual stocks. So since I last reported on this, the percentage of my money that is in low-cost index funds has gone down slightly from 66% to 64%. And the individual stock positions have gone from 34% to 36%. So just to recap that really quickly, and I'll get into the more interesting details. I'm 64% low-cost index funds and 36% individual stocks. One of the reasons why my percentage of my money that's in indexes can shrink is not just because I'm not buying it or that I've loaded up on an individual position. There's also the tendency, especially in these updates, where you could have one name in the individual portfolio really take off a bit. And so it just increases the percentage. But generally speaking, I want to see myself move towards more of a 70-30 split. I'm not set on, like I have to hit that, but just doing these allocations is a good way to see if I'm on track. Now, my reason for this, and if you've listened to episodes in the past, this won't be totally unfamiliar. Individual stock picking tends to be very bad for us as individual investors over the long term. So I'm continually working at getting better and better and better at all the different skills you need to be a really sound investor. But with that said, I still want to make sure I keep my overconfidence in check. The other reason, and this is kind of like very much a CMQ Chris Franco reason that maybe doesn't get discussed as much, but I know for a fact that when there's market volatility or like a market correction, I'm not tempted to sell anything that's in a low-cost index fund. Like my low-cost index, whether it's the VOO or VTI, the market can go down 50%, and I'm not tempted to sell. That's not always the case with individual stocks, and while I've improved on that level, I still want to keep that in mind when looking at that percentage, because I just know there's more room for me to screw it up if the psychology element isn't 100% down pat. Panic selling is a great way to interrupt the compounding process. And I was recently reading one of these like official non-biased reports on investor behavior. I'll try to remember the name of it later, and I'll share it through the newsletter. But in pretty much every market crisis, the best course of action for investors to take is to do nothing. And that very much aligns and agrees with the reality that I think I've started to see thanks to people like Charlie Munger. There are huge mathematical advantages of doing nothing. You avoid interrupting the compound process, and if you have a long enough time frame or time horizon, these things happen. And so you just want to, get through it and let things correct themselves before you try to intervene and make things worse. A mental model to consider here is one called iatrogenics. Here's what that tells us. Sometimes in like the medical world, more harm is done through intervention or through the attempt to treat the issue than just by leaving it alone. So I keep that in mind. Also, another model, if you guys like sports, when they do kickoff or penalty kicks in soccer, or depending on where you live, football, when the goalie can go left or right, depending on where he or she thinks the ball is going. But there's evidence that just by staying in the center gives you a better chance of actually blocking the shot, because most shots go to the center. So again, it's like doing less gives you the chance to you have better odds at doing better. On that note, what's in the individual portfolio and what has changed? So my individual stock portfolio, it's right out of the Warren Buffett portfolio. I own a concentrated set of stocks that are all based on what I believe are companies that I believe have a high probability of doing above average over the long haul. So my job is to not try to know everything about everything, but apply some really simple filters and narrow things down that way. And that's what I've done. If I break down now just the individual stock portfolio, the number one position still is Apple, and that's actually 33%. Apple is a company that I started buying in 2015. I believe my reason was something very, at the time, superficial. I saw Apple products everywhere. I was using Apple products. It just made sense to me. And I have kept buying, and that's done very well. I now have a much more detailed, thorough reasons to own it, but back then I'm just acknowledging my own ignorance. The next up, and this is a big change, Alibaba is now number 2 with 24%. I'm taking a page out of the Munger book. When those opportunities come along, and they don't come along often, you load up. some of the biggest mistakes, as he's mentioned in the past, are errors of omission when you've not done something that you should have done or not done enough of it. So I think if I look back at this in 20 years, I think I'd regret not taking a big chunk, but I also acknowledge that it might not work out. Look, anything can happen, but I think it has an above average chance of doing above average over the long term. If you'd like to hear a more complete set of reasons why I am bullish on Alibaba, all you have to do is go back about 5 episodes and listen to the episode titled Why I'm Bullish on Baba. That episode was released on December 28th, 2021. It's about 15 minutes long, and I think you'll enjoy it a lot. Next up is Berkshire, 16%, then Microsoft, 10%, and finally Costco, 6%, and Intuit, 5%. Very much a concentrated portfolio. It's built to do better than the index, but it's also knowing that there's going to be higher peaks and valleys in the short term because it's so concentrated. The way I try to approach what I invest in is just as simple as possible. So I'm using opportunity cost over anything else. For example, someone could say you should sell some of that Apple. I just don't know what else to do with that. What would I do with that money? I'm gonna have to pay the taxes on it, which, I prefer to delay that as long as possible. I would be able to if I keep on holding. But then I also have to find something more intelligent to do with that money. And I just don't have any other ideas right now. And I've learned from Charlie Munger, good ideas are rare. And so you just got to keep working at preparing your mind so that you can spot the opportunity when it presents itself. So that's kind of my thinking right now. I hope that's useful to you guys. Just sharing my portfolio as a fellow CMQ investor, not as financial advice or anything like that. With all that said, I want to thank you again for listening. You can follow up on any news about my personal portfolio through our free newsletter, which you can subscribe to at cmqinvesting.com. Make sure, as I said before, you follow the podcast on Apple Podcasts or Spotify so you'll never miss an episode. And if you enjoy the content, please take a second to rate us 5 stars. And if you're on Apple Podcasts, it would mean a lot if you could take a few minutes to write a written review. Those go a long way in helping more people discover this content. Last but not least, if you are a new listener, there are 60, actually more than 60 additional episodes for you to listen to and enjoy. They're all meant to be short, full of wisdom, useful, honest, transparent, every good adjective you can imagine. So on that note, this has been Compound Money Quietly, the CMQ Investing Podcast. My name is Chris Franco. Thank you for listening. We'll talk soon.